This inflation we're dealing with isn't something that just popped up recently. It's been around for about 90 years if you trace it back to 1933. That's the year when the gold-dollar exchange rate was set at $35, thanks to FDR and his advisors who adjusted it from $21. This shift from $21 to $35 was a significant move to stabilize the economy, but since then, the constant money printing has been a reality. They kept up the facade of a $35 gold exchange rate until 1971, when they finally admitted it wasn't true. So, this inflation has roots going back to that change. As for whether it can keep going for another decade, I doubt it. Back in the 90s, debt wasn't as prevalent. People in my middle-class neighborhood generally had savings and a decent standard of living. But things shifted around 2006, 2007, when people started going into debt to buy homes, and that's left a lasting impact. Now, it seems like everyone is in some form of debt, except for the wealthy. I think we're at a tipping point where things might start to unravel, and while I can't say for sure how long it'll take, it could be a few months to a year before we really see the effects. There's a lot happening beneath the surface of the monetary system, and it feels like any little thing could set off a chain reaction that no one saw coming. Based on past events, I think we're headed for a gradual decline in the dollar's purchasing power. I'm not talking about its value against other currencies, but rather what you can actually buy with it. Prices are likely to keep climbing, and most people, especially those who really understand fiat currency, recognize that this situation isn't sustainable. The system is built on accumulating debt that never really goes away, which just isn't how nature operates. Eventually, when it becomes clear that the dollar is losing its value, things could shift rapidly, maybe in just a few weeks or even days. We've seen hyperinflation before, in places like Israel in 1984 and Germany in 1923, but those were isolated incidents tied to specific currencies. This time, it's the dollar itself that could crash, leaving other currencies in a tough spot. They might have to revert to gold, or we could see a complete breakdown of the monetary system, leading to a rise in private currencies. In the long run, things might improve, but in the short term, expect a lot of chaos. Just look at the inflation spike that happened from 1918 to 1923 after World War I.e. It really took off around mid-1923. The only thing that kept it in check was the slow distribution of physical cash, which had to be transported by train and handed out in person. Nowadays, though, payments are instant with options like Bitcoin or Apple Pay. In my view, Bitcoin is just another version of dollars, but you can spend it all in a flash. We've never experienced hyperinflation in such a tech-savvy world before, especially with a currency like the dollar. It's possible to see food prices double in a month and then double again shortly after. We've seen similar situations before, but never on this scale with the current money transfer technology. I can't predict exactly what will happen, but it's wise to prepare yourself now. The dollar's value hinges on its ability to be exchanged for gold, but if everyone tried to do that, gold could skyrocket to around $40,000 an ounce, based on the Fed's balance sheet compared to the gold reserves backing it. The balance sheet tells a story, especially when you look back at the Great Depression and the economic fallout that came with gold's price jump from $21 to $35, which was around a 60% increase. Just think about the chaos that would ensue if gold suddenly shot up to $30,000 in just a few weeks. It's a scary thought. But really, it's not just about gold getting more expensive, it's about the dollar losing its value and purchasing power. If the exchange rate between gold and the dollar were to spike to $5,000, people would rush to cash in their gold, and it wouldn't stop there. Once it hits $5,000, it could keep climbing, revealing the true monetary exchange rate, assuming there's still gold in Fort Knox. The real concern is that this decline in the dollar's purchasing power won't be gradual. It could jump from $2,000 to $3,000 overnight. If you look at commodities priced in gold in that scenario, they might actually seem pretty cheap because gold is the real currency that gives the dollar its value. So, as we approach those higher numbers, like $4,000 or $5,000, it's going to be the free market that drives the dollar down. When you look at the balance sheet of the Federal Reserve and divide it by the Mana Golden Fort KNX, you start to see how monetary parity plays out. Once you hit that 5,000 mark, you'll quickly find yourself back in a free market scenario. A lot of folks, including those getting drawn into Bitcoin, really don't grasp the true nature of money. When we trade money or currency for things like food, houses, or cars, we're essentially swapping gold for those items, even if we don't consciously recognize it. The big financial players, the ones who want you to gamble on contracts, are making massive moves in gold and then cashing out for profits in dollars. They don't see gold as money. To them, it's just a shiny asset or a store of value, and they have their own definitions of what money really is. Gold serves as a reliable store of value, and it also functions as a unit of account, among other roles that define good money. Essentially, when you make a purchase, you're either using gold directly or a substitute for it. Currently, the price of gold in dollars reflects its industrial value rather than its monetary worth. However, when the demand for real money rises, gold becomes essential, and its value in paper currency could soar to around $30,000. The reason gold is considered money goes back to the origins of currency itself. Each day, you wake up with a clear understanding of your financial situation, how much you need to earn and spend based on your past experiences. This ongoing cycle of knowledge about your finances helps maintain your standard of living. No government or organization can simply create a currency system and enforce prices by law. It just doesn't work that way because the distribution of value is inherently tied to real economic activity. Understanding supply and demand for any good or service really comes down to market actions. Everyone needs to work together based on what they have, what they need, and what they can afford to figure out how much of something is available and how much people actually want it. You can't just rely on fiat currency to make these determinations. It all has to come from real market interactions. A monetary system can't just be created out of thin air. It needs to be tied to something that already exists, something that reflects past transactions. Money originated from the simple need to trade. People had items they wanted to exchange for other items, and the most convenient things to trade turned out to be gold or silver. There was no central authority orchestrating this. It just happened naturally because gold was a reliable medium of exchange, and that's how all paper currencies eventually came to be.